Welcome to today's NOVA presentation, Mandatory Automatic Enrollment After the Proposed Regulations, with today's presenter, Craig Hoffman. Before we get started, I'd like to point out the question mark icon at the top of your webinar screen. This is where you will enter in any questions that you may have for Craig. Feel free to submit your questions at any time. Keep in mind that the Q&A portion will be held at the end. If time runs out and you still have questions, you can send them to our email address, webinars@nova401k.com. Right next to questions, you will see a paper icon. This is our handouts dropdown in which you can find today's material in PDF form. If you are unable to view or click on the handout, go ahead and send us an email and we can provide you with that PDF. If you are with us today to earn continuing education credits, please be sure to stay until the end. There will be a pop-up survey for you to fill out. This is going to allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, or you can visit our website, which is www.nova401k.com/webinars. Thank you so much for joining us today. I would now like to introduce today's presenter, NOVA's attorney and senior consultant, Craig Hoffman.
Thank you, Yvette. Welcome, one and all. Good morning to those on the West Coast. Good afternoon to everybody else. We're happy to have you join us for another one of our NOVA complimentary webinars, and I'm happy to report it's entirely American-made parts, so we don't anticipate any impact from the forthcoming tariffs on future webinars. Hopefully you can join us there. Moving on. The disclaimer, this is just general information, not meant to be tax advice. If you need CPA credit, I believe this is Texas CPA. We do have a provider number there, but for ASPA, NIPA, and others, you shouldn't have any trouble getting CPE credit by staying on and getting the certificate. This is who I am. Been around for, some would say, too long, but I've had the pleasure of working in this industry for over 40 years now, and I found a home at NOVA in my semi-retirement years, but I'm staying very actively involved with all that's going on, and I'm happy you can join us. Hopefully you'll find the time spent worthwhile. And although that is me, I am most proud of the other member of my family who seems to pop up at these webinars. My little girl, Fergie, she's a little over 3-year-old, mini golden doodle, the love of my life after my wife and daughter. But that picture was taken at the dog park this past weekend after she had just come from the groomer. So she had the cute bandana on, and we're heading to the dog park after I finish this webinar. So glad you got to see Fergie. She's actually laying right at my feet. So unless a FedEx driver shows up, I don't think you're going to hear from him. Moving on. Okay, so what are we going to talk about? We'll begin with some background, and then we'll jump into the nitty-gritty of Secure 2.0, beginning with which plans need to worry about this automatic enrollment mandate, and then flow into the requirements if you are subject to the mandate. As time permits, we'll pick up a couple of topics near the end that dealing with potentially the benefits perhaps of QACAs these days, as well as correction options and the small enrollment, automatic enrollment, small employer automatic enrollment tax credit. Moving on. So what is automatic enrollment? Well, what it is the plan provides for a default contribution percentage that will be made unless the participant makes an affirmative election for no deferral or a deferral at a different rate. Back in the old days, this was known as a negative election. The idea an affirmative election was to participate. A negative election meant you are participating unless you negatively elect out. And they've been increasing in popularity, these types of designs. The default election does always stop once a participant makes it an affirmative election, either to contribute at a different rate or no contributions at all. But The automatic enrollment provisions began growing in popularity in the late 90s. There were a couple key IRS revenue rulings that came out in the 90s that ordained the use of this negative election automatic enrollment feature. The automatic enrollment has been touted as beneficial to participants because data has shown that, in fact, savings rates and participation rates are higher in plans with automatic enrollment. The downside has always been the administrative hassle of having to ensure people are properly enrolled at the right rate, and if there's auto escalation, that they are properly escalated. So there was some reluctance. Back in 2006, Congress stepped in with the Pension Protection Act, which was the first really congressional blessing and support of automatic enrollment, and made some important changes. It preempted any state laws that prohibited a garnishing of an employee's paycheck without their permission, without their consent. There was some question whether ERISA superseded it. Congress answered that. It added the QACA type of safe harbor, automatic enrollment safe harbor design. It provided the EACA, which gives you some extra benefits, you might say, as a payback for the employer taking on automatic enrollment. And it's hard to imagine, but it was really only, 18 years, 19 years ago that Congress told the DOL to write those qualified default investment alternative regulations, which in turn has been a very important part of not only automatic enrollment, but frankly, any plan with directed investments. So, PPA left us with basically the EACA type of arrangement, which really it's not a safe harbor. It's prime. The benefits of using it are the potential relaxation of a couple of rules that we'll talk about. So that's beneficial. It also added the QACA. So that was the second type of, if you will, statutory automatic enrollment arrangement. And then there was everything else, and everything else was fine. Nothing wrong with an automatic enrollment arrangement that was not an EACA or a QACA, at least in the past. But as we'll see going forward, for plans that are subject to the mandate, the Secure 2.0 mandates that arrangements qualify as an EACA. So EACAs are going to dominate, if you will, on a going forward basis. And so that's where we stood until Secure 2.0. And so in 22, the Congress took it much further by not just providing reasons, encouragement to employers, but made a mandate that beginning with the 2025 plan year, most 401k and 403b plans established after December 28, 2022, which was the day before the new law became effective, that if you're not grandfathered, you will need to include automatic enrollment as a mandatory plan design feature. And that mandatory design feature has to meet certain parameters that are set forth in Secure 2.0, including being compliant with the EACA rules. So that was in 22. We got a little bit of guidance at the beginning of last year in the form of Notice 24-2, but it was not meant to be comprehensive, and in fact wasn't. And in January of this year, 3 months ago, the IRS published proposed regulations that will provide guidance on the changes made by 2.0. Now, those regs came out 14 days after the new law was applicable, if you will, to many plans, not necessarily existing plans, but so the proposed regs came out 2 weeks late, and people have already been moving forward and what have you. And so what the IRS did is provide that in the interim you can follow a reasonable good faith interpretation of what Secure 2.0 requires, and until such time as final regulations are issued. And final regulations, the the IRS promises us, will not be effective any earlier than the first plan year beginning 6 months after they're published as final regulations. So, knowing how the IRS operates, I think there is little chance they will finalize these regulations before the 1st of July of this year. So that means for calendar year plans, the earliest, assuming that's the case, that the regs won't be applicable until the 2027 plan year. And I would go on, and so we have time, but even with that said, it would not at all surprise me to see these regs drag out to beyond the final regs being published after July 1 of 2026, which means for calendar year plans, they won't be effective until the 28 plan year. So we need to monitor that. It remains to be seen how efficiently the IRS puts out regulations in the new administration. From what I understand, the people in employee plans and in the chief counsel's office who work on employee plans are in there toiling away. But there's some concern that as these final regs drift up through the approval process to higher levels, they may be slowed down. So the good news is we will have time to prepare for the final regs, and in the meantime, a reasonable good faith interpretation is sufficient. Now, the regs don't say following the proposed regs will be considered a good faith. They didn't even go that far. I would think certainly that would be a good faith approach, but it seems to me there's even more leeway potentially in the manner in which the good faith standard was put into the proposed regulations. So, what plans are subject to the mandate? As we've already said, the plans established on or after uh, uh, it only applies to plans established on or after December 29th. So if you were established by December 28th of 2022, that's referred to in the proposed regs as a pre-enactment plan, and it is grandfathered. The notice 24.2 and the proposed regs are consistent in saying that a plan is established on the date the terms that provide for the cash or deferred arrangement are initially adopted. And this is true even if the CODA is not effective until sometime later. And for example, if you adopted a 401k with a CODA in December of 2022, December 15th, and it became effective on January 1st of 2023, that plan would be grandfathered. The Interestingly, and to be honest, I hadn't picked up on this. I'm not sure it was clear anywhere, but in the proposed regs, 403B plans are considered established when they are initially adopted without regard to when they include a cash or deferred or salary reduction agreement provision. So 403B has to be established. In the case of the K plan, the CODA has to be adopted, even though later effective. We did get some clarification of how the rules will work in the case of mergers or spinoffs of plans. And it's really a pretty simple rule. If a pre-enactment plan merges with another pre-enactment plan, that surviving plan is still grandfathered. If a pre-enactment plan spins off part of the plan to a new plan, that spun off plan retains its pre-enactment status. On the other hand, if a pre-enactment plan is merged with a post-enactment plan, the ongoing plan loses its grandfather exemption and will have to provide for automatic enrollment for the entire surviving plan unless, and this is a big unless, it's a little complicated, but it is out there to consider, and that is if the merger of the plans is in connection with a transaction described in Code Section 410B6C, which, if you don't have that memorized, that's the section in the coverage rules that give you a transition period before you have to apply coverage to a newly made up control group. So the transaction that is described is a transaction in which either an entity joins or an entity leaves its group of related companies, either under the control group rules, the affiliated service group rules, the affiliated management rules. You get it. So it's got to be that type of a transaction. The pre-enactment plan that's merging with the post-enactment plan has to be designated as the surviving plan. And then lastly, and this is an important lastly, the merger has to be affected during that 410B6C transition period, which consists of the plan year in which the transaction occurs, and the following year. So you'd have anywhere from 12 months and 1 day to 23 months and 30 days or what have you. You get my point. Um, the IRS has gotten comment letters on the proposed regs, and some folks have taken issue with the idea that the pre-enactment plan has to be designated as the surviving plan. That seems like a potential easy footfall that shouldn't be left out there uh, for a mistake to be easily made. That's not really clear. I guess there is a method to designate the survivor, but it really doesn't matter typically that much. And there's been some concern that the planned merger must occur within the transition period because sometimes a new company joins the fold. They have their own plan going on, and it's a couple years before they are brought into the fold and merged. In that case, the merge plan, if it's after that period, would have to have auto enrollment, or alternatively, you could freeze the post enactment plan and just put everybody into the pre enactment plan of that group of related employers. We'll come back to that in a second. That comes up a little bit later in the presentation. You already talked about spinoffs. MEPs. There was some wording in the notice 24.2 that seemed to imply that if a pre-enactment plan merged into a post-enactment, a MEP that was established after December 22nd of 22, December 28th, excuse me, of 22, that it would lose its status. And there was a lot of comments that went in on that IRS notice taking issue with that. And in fact, the IRS backed off, or at least clarified that's not what they meant. So that the status of a plan that is established through adoption of a multiple employer plan is determined on an employer by employer basis. So it is irrelevant what date the MEP was first established. So that means employers who have a grandfathered plan who choose to merge that into adopt a MEP, they can remain grandfathered. And the same would be true if you had a new plan that was established in a MEP before December 29th, and that's later spun off from the MEP. So that makes great sense. A lot of the MEP providers were very worried that somehow they would be precluded from, if it was established, the MEP after December 28th of 22, it would not be able to offer any grandfathering for any employer who might later merge into it. That's now been resolved. Interestingly, a plan's grandfather status is unaffected by any plan amendments, changing the design or features of the plan, with the one exception of adoption of a MEP or a plan merger amendment, which is subject to the rules we just talked about. And the proposed regs specifically provide that the grandfathering continues to apply even if the employer amends the plan to expand eligibility to other employees of that employer or expands eligibility to the employees of a related employer under the controlled or affiliated service group rules. So that's what I was getting at earlier. If you had a post enactment plan and a pre enactment plan, but didn't merge it in the 410B6, you can still freeze that post enactment plan and simply open up the grandfather plan to those employees of a related employer. So, in addition to the grandfathering, and clearly that's the biggest exemption out there, but there are some standard exemptions that apply, will continue to apply in the years ahead. Simple 401k, and I guess more importantly, simple IRAs are not subject to this mandate. And I say more importantly because simple Ks have never been very popular, but simple IRA plans uh, do have a place and time and a good market for them. Church and governmental plans are not subject to this mandate. And then we have the new business exemption. Plans sponsored by an employer that has been in business for less than 3 years is does not have to comply with automatic enrollment until the first plan year beginning 3 years after that employer came into existence. And I skipped over, but it's the employer is aggregated with any predecessor employer if there is one in determining that 3 year period. So, for example, a new business formed on July 1, 2025 starts up a 401k plan 1/1/26, and because it's a new business, they are not required to have automatic enrollment in the 26 plan year, the 27 plan year, or the 28, because it's July 1, 28 when they've been in existence for 3 years. And so automatic enrollment would have to begin on January 1 of 2029 in that example. The predecessor employer is not defined in the proposed regs, and the IRS acknowledged that by specifically asking for comments from interested people as part of the public comment process on the proposed regs, comments on whether there actually is a need for a definition of predecessor employer. And I think there is personally. Otherwise, it's all touchy feely. There's, I think, in the 415 regs, a definition application of predecessor employer that's still facts and circumstances, but looks to whether the subsequent employer is substantially continuing the business of the predecessor, which is not exactly a bright line test. So uh, we'll see. I would expect we'll have something more objective by the time we get to final regs. Until then, a good faith approach would be reasonable. An important point I made, as I mentioned, governmental and non-electing church-sponsored plans are exempt from the mandate, and a lot of 403B plans fall into that category. Think of public schools, universities. But there are a large number of 403B plans that are sponsored not by a government, not by a church, but by a charitable organization, a 501c3 organization. And those 403B plans are sometimes designed to not be subject to ERISA. There's a DOL reg, it's in the bottom bullet on your screen, that defines an exemption from ERISA for 403B plans where the employer's involvement is limiting to collecting by payroll deduction the employee contributions. There's some OR requirements in there, including that the employee, uh, the, among other things, that the employee's participation is completely voluntary. And the question arises, if you are automatically enrolling somebody, is that a voluntary participation? Now, you can surely make the argument it is, because the person doesn't have to keep that contribution. He or she can simply take action so they don't participate. And I could certainly make that argument, but years in the past, and I'm not sure if this has come up recently, at least not until this law, Secure 2.0, but in the past, in informal conversations I've had with DOL people in my past life at ASPA, was their opinion that automatic enrollment was too much employer involvement. Now, granted, back then, automatic enrollment was not mandatory. And so the employer was getting involved in designing the plan that way. Now it's a mandate. So I don't know. The one important point I make, however, is that the long-term part-time employee rules only apply to 403B plans that are subject to ERISA. And so it raises the question, if you have one of those plans that's trying to be exempt from ERISA, but now has automatic enrollment, obviously it would be a new plan, then it remains to be seen whether you blow your ERISA exemption such that you're now subject to the long-term part-time employee rules. Craig, you're so uplifting, giving us all this great news. I'm just here to cause them as I seize them. The other exemption worth talking about, the other main one, is the law reads that plans sponsored by employers who normally employ no more than 10 employees are exempt. If the employer goes above that 10 employee threshold, the mandate will apply 1 year after the close of the first tax year in which the threshold was breached. Now, the proposed regs gave us some clarifications, one which kind of surprised me, but in any case, only common law employees count toward that 10 employee threshold. So that would exclude partners in a partnership that's taxed as a partnership, or sole proprietors as well. Again, that might be significant perhaps in some of the doctor partnerships, for example. And there was no definition in the statute of what normally employ means, and so the IRS gave us one. It's determined under the rules that are used for determining whether employer is required to provide uh, COBRA coverage, health insurance coverage, after somebody terminates employment. And there's a phrase used in that statute that's identical, normally employed. I think it's 20 employees or 50 for COBRA. But in any case, if you go to that reg, which I've cited in my materials, you'll find that it's a convoluted way of counting employees, that you cannot have to be normally employ 10 or less. You can have no more than 10 employees on your payroll during at least 50% of the business days in a year. And you can do that by looking at each business day individually, or you can look at it by determine it on a payroll basis, your payroll computation period. But whatever method you use, it's got to be consistent for the entire year and apply to everybody. And under this rule, full timers are counted as a one full time employee, but then you have to calculate, if you will, full time equivalents that count for the part timers. And so you look at how many hours they work compared to a normal full-time employee, and from that prorate and determine how much of an employee you have to count. Now, if you think this is really bizarre and nobody's going to be able to do it right, you're probably right. These are small employers, remember. Do I have an answer for it? No. I mean, the IRS has been asked for something easier to apply in comment letters, but I'm not sure they're going to do it. So the only advice I might give is don't, I'm just out here talking, is bite the bullet, even for a small employer, if you're close. I mean, if you know there's only 3 employees on the payroll all year long, you're not worried. But if you got a bunch of part timers and the like, and it's going to be difficult at best to calculate the exemption, then just live with it. And I should further add that my reading of the proposed regs is that if you go over that 10 employee threshold in a year, you are forevermore subject to the mandate, even if you drop below 10 at some later date. But that too is a question that's been put up for comment, or that commentators have raised for clarification. So what does we know what plans it's the rules are applicable? What do they have to do? Well, they've got to qualify as an EACA. I've already mentioned that. They've got to have a minimum default contribution schedule that auto escalates. They have to invest amounts for which the participant fails to give investment direction in a QDIA, qualified default investment alternative. And the plan must provide for permissive withdrawals under the rules of IRC 414W2. I'm sure you had that code site right on your tip of your tongue. All right, so everybody's got to be in an EACA. In the past, EACAs were voluntary. They have certain benefits. The EACAs, though, for pre-enactment plans have two options that they can still qualify as an EACA with or without these options. Option one is the ability to make a permissible withdrawal, which during the first 90 days of auto enrollment, it allows a person to wake up and say, give me my money back. That is optional for pre-enactment EACAs. It's mandatory for Secure 2.0. Similarly, the EACA can but is not required to provide a QDIA investment for participants who don't give investment direction. In PPA 06, actually, that was mandatory, and then they dropped it in a later technical corrections bill, I think it was. But once again, the best, not every single EACA, pre-enactment EACA, allows permissible withdrawals. That won't be the case for the mandated plans. I would say 99% of 401k plans with directed investments have QDIA alternatives available in case a person doesn't give direction. So I don't think that part of this will be that difficult to adjust to, with one possible exception. We'll come to that when we go into greater detail. The benefits of being an EACA, and this is what Congress was throwing out, a big reason why you want to be in an EACA, you get an extra 3.5 months. That's right, 3.5 months to correct your failed ADP or ACP test through a corrective distribution and still avoid the 10% penalty. If you that extra 3.5 months gives you a longer time to do your calculations. But in order to get that 6-month extension, all employees, all participants have to be covered by the EACA, which is not required for pre-enactment EACAs, but it is required for what we're dealing with. And we'll go into what that really means in a moment. In addition, the plan must permit in-service permissible withdrawals. Again, this was a benefit because in the old days before PPA 06, the problem another reason why employers didn't want to have automatic enrollment is because you would automatically enroll a participant who didn't read any of the notices they were given. They get their first paycheck and $50 was withheld, and the employee says, stop withholding. I didn't agree to that. The employee says, fine. And the employee says, I also want my $50 back. And if you don't have permissible withdrawals, you can't give it back. So to avoid potentially small account balances, there is a real benefit of allowing a permissible withdrawal. And again, for non-grandfathered plans, it's going to be mandatory. So, which we said all employees of the IACA have to be covered in a secure 2.0 mandate plan. Not so much for not required for pre-enactment IACAs. But what it does mean, therefore, is long-term part-time employees are participants in the plan who, therefore, must be automatically enrolled when they become eligible. The proposed regs in the preamble specifically addressed this and said there's no statutory basis for an exclusion of LTPTs, and so you'll have to continue to cover them. The only exception really is for employees who make an affirmative election to contribute or not contribute to the plan. If they have an affirmative election, they don't have to be covered by the IACA's provisions as such, and you don't blow your IACA status. A question arose because the new law was enacted in 22, but didn't become effective in 2025 till 2025. There were plans adopted in the interim, new 401k plans that will be subject to the mandate, but were not subject to the mandate in 2023 and 2024 when they were first adopted. So now we come to 2025 and they've got to implement automatic enrollment. And the questions that were raised, well, what about the people who began participation in 23 and 24? They're already in the plan. Do we have to now automatically enroll them because of this change in the law becoming effective? And the answer the IRS gave is yes. However, they did provide some transitional relief for that class of employees who became eligible after the new law was adopted, but before it was effective, that you do not have to automatically enroll them until the first plan year beginning 6 months after the final regs are published. And so, again, we're looking at the 2027 plan year and potentially even the 2028 plan year before these folks will have to come into the plan. The default contribution rates, if you begin at least 3% and no higher than 10%, and then you auto escalate up until the employee reaches at least 10%, and you can't auto escalate to anything more than 15%. Now, the schedule follows the similar rules to what the QACA has, in that it's not the first plan year that you're at 3%. It's the first initial period of participation, which is the plan year you enter, as well as the remaining, the following plan year. So if I enter a plan July 1st of 2025, for a calendar year plan, my initial period will be for 2025 and 2026. The remainder of when I came in and a whole nother plan year. And that during that initial period, I'm at 3%. And then for each plan year thereafter, the default rate can increase by 1% on the first day of each plan year. That's the way the statute reads. Now, it's not clear that a plan can escalate more than 1% per year. You can start at 10% if you want, and then you're done. You don't have to escalate any further. But if you want to start at 3 and escalate 2% the first day of each, plan year thereafter, the proposed regs don't address that. To the contrary, you can reach an inference that you can't do that. So that's a question I know that's been raised by a number of comment letters. Similarly, there's some question if you can affect the change mid-year, auto escalate mid-year rather than at the beginning of each plan year. And some folks, some plan designs like to auto escalate at the employee's anniversary date or at their review date when they get a bump in pay or something like that. And we don't, it's not clear. Again, reasonable good faith, you can probably do it for now until it's till it's confirmed by the final regs. And I come back to the point I've made since this law was enacted. If you don't want to deal with auto escalation, there's an easy way to avoid it. Start everybody at 10%. Now, that will typically get an employee's attention. And if they don't want 10%, that will move them to action to change their deferral election. And it's totally up to them. So I'm not sure an employer should feel bad about that, particularly if you have some good communication ahead of rolling this out so people know what's happening and they still control it. They don't have to do 10%, but that avoids all this administrative hassle of figuring out the right escalation for the right year. Um, Auto escalation continues even from your initial year of eligibility. It goes up after the initial period each plan year, even if you're not working there during that plan year, or you move from being eligible to an excluded class, or it can apply if an employee is the old period schedule where you stood on it will continue to apply even if you are required to re-enroll employees after if the employee is required to re-enroll after already making an affirmative election. So that requires some tracking. There is a rule that says, however, you can redetermine the initial period and begin again at 3% if the participant had no default contributions made for at least one full plan year. So it's not a calendar year or what have you. It's a plan year. So if an employee uh, uh, had a default contribution made for the beginning first week of the plan year and then left and doesn't come back until February of the next year, you don't have the ability to redetermine for that person because they had no they had default contributions made during that year. That if you do want to have a refresh, a clean start on the schedule, the initial period begins when the employee is eligible again. For somebody who was ineligible, if you're doing a refresh of all elections by requiring employees to make new affirmative elections, the initial period can be reset for those with no default contributions, uh, but it's got to begin after the initial period, the original initial period had ended, which can be somewhat problematic depending on when the employee left. This is actually different, slightly different than the QACA, and several comment letters have requested that these rules be made more consistent because there are going to be QACAs that qualify as that meet the mandate that are going to be used, and we need some consistency. Uniformity. There's a requirement that the default contribution rate has to be uniform for all participants in the plan. And plan for this purpose is defined under the coverage rules. So if you've got a union employees who are subject to a collective bargaining agreement where retirement benefits were subject to good faith bargaining, they're in a separate plan and could have a different default rate. Similarly, if you've got unrelated employers in a multiple employer plan, they are disaggregated for coverage testing and therefore would be disaggregated for purposes of this rule. Now, the uniformity rule does accommodate certain um, popular designs, namely the ability to have uniform rates that vary based on the years since the employee first had contributions made under a default election. So this accommodates auto escalation, that it's not uniform if the guy on his initial period is getting 3% and the guy who's 5 years in is getting 8%, whatever. But that's okay as long as it's based on years since you first had default contributions made. Pre-existing elections don't need to be reduced, and if a default percentage contribution would actually, at the uniform rate, would violate 402G, the 415 limits, or the comp limit, you don't have to make it that as uniform. IACA, again, we're still on the IACA. They've got to receive a notice, sufficiently accurate, comprehensive, calculated, written to be understood by the average eligible employee. The IACA notice is pretty much built on the framework of the safe harbor notice. If it's a safe harbor plan, the IACA notice needs to include the same information that you would normally put into a safe harbor notice. But then you have description of the default elective contribution rate. Tell the participant you can make a different contribution, explain how amounts will be invested if you don't direct, and if there are permissive withdrawals, which there will be on secure mandated plans, the procedures for the right to make one and the procedures for doing so. Timing, same as the safe harbor notice, a reasonable time before the beginning of each plan year, 30 to 90 day safe harbor window ahead of that plan year. If a newly eligible participant can be given the notice as early as 90 days before eligibility and as late as the date they become eligible to satisfy the IACA notice. And in fact, even a little later, if for a newly eligible participant, if you can get the notice to him or her in time for them to read it and consider what they want to do before the first payroll out of which a deferral is going to be withheld. Must be in writing, distributed in accordance with the IRS regs, electronic disclosure. It can be combined with the safe harbor, as I already mentioned, for quackas. It can also be combined with the QDI notice. And in fact, the IRS has provided a sample notice that for a safe harbor plan that has a QDIA and includes permissible withdrawals, so it covers all the bases. It's a little unwieldy as a template, if you will, but it's worth taking a look at, and you can get it on the IRS website. There's a link to it in my slides. Permissive withdrawals, and by the way, sometimes the regs in the code it's called a permissible withdrawal, but the regs sometimes call it permissive, sometimes permissible. And to be consistent with the regs, I go back and forth myself. So this is, again, it allows newly eligible employees to cease deferrals and withdraw the initial deferrals that were made under the arrangement. The election's got to be made at least 90 days, within 90 days of the first deferral being withheld from an employee's paycheck. So it's not your initial eligibility date, it's the first pay date that you would have had money that you had a default elective deferral withheld from. So 90 days is the max. You can set a shorter period, but it must be at least 30 days pursuant to the IACA regs. And the election to stop with withholding default deferrals must be effected no later than 30 days after the participant gives you that election, or if earlier, the second payroll that begins after the date the election to withdraw is made. So it's basically dealing with the fact if you had something uh, less frequent than monthly payroll. Uh, the IACA notice has to describe permissive withdrawals. If you take a permissive withdrawal, it is taxable. If it was a pre-tax deferral, it's taxable in the year of distribution. It doesn't relate back if you crossed over years by some chance. If it's Roth, the Roth basis portion is not taxed a second time. Only the earnings on that Roth contribution, and basis is determined by assuming the withdrawn deferral was the only Roth amount in the account. So it's basically just the earnings on that deferral over that period. There's no 10% withdrawal penalty. It's not an eligible rollover distribution. So voluntary withholding in the absence of an election, 10%. And reported on Form 1099-R. And if you need spousal you don't need spousal consent, even if it's a plan with QJSIs. Now, this is, I'm glad I got to this. We're going to start picking up the pace a little bit here, but permissive withdrawals under the IRS regulations for IACAs, it says it's fine to charge a reasonable fee for processing the permissive withdrawal as long as it's not any more expensive than the lowest distribution fee you otherwise have. Well, that's great. However, if the plan is using a QDIA, the DOL regs, and I've cited it on the sheet, on the slide, in my opinion, precludes the putting a distribution fee on that permissive withdrawal. You can read along with me. The prohibition of fees on the QDIA withdrawal shall not apply to fees and expenses that are charged on an ongoing basis for the operation of the investment itself. And this is the exact wording, such as investment management fees, 12B1 fees, legal, accounting, or transferations, or similar administrative fees. Now, I skipped over distribution. And I've had folks say to me, well, it's a distribution fee, but I don't think that's not what we're talking about, because that's dealing with the investment itself. And keep in mind, the initial clause is further modified by the word "and," so it's got to be these ongoing fees, and they may not be imposed, may not vary based on a participant or Benny's decision to withdraw, sell, or transfer assets out of the QDIA. And I have not found anybody at DOL who's willing to talk to me these days. And I've had a disagreement with my good friend, longtime fellow colleague at SunGard and at ASPA some, Robert Richter, who poo-poos my concerns about this, but I leave it for you to decide as to what the right answer is. I think I have the right answer, but I'm just a voice in the wind. Uh, you cannot restrict the employee's right to make deferral contributions just because he or she made a permissive withdrawal. If there are any related matching contributions to the amount that was withdrawn, they've got to be forfeited, and amounts withdrawn are not taken into account for your ADP test. And if they're forfeited match, they're not counted on the ACP test. All right, that gets us to QDIAs, and I'm going to go through this quickly. I mean, this is not new stuff. We've had QDIAs since PPA 06. The idea is if you have directed investments, but the person won't direct his or her account balances investments, then you can put in a default investment alternative that complies with the DOL regs, and the fiduciary will still have protection. The one question that is raised by this that I did want to make sure to cover that is new is that what about a plan that has that we call a pooled plan? And by that I mean a plan where this is old timey, folks, but there's still a few of them out there. A 401k plan where the trustee of the plan is the person responsible for making plan investments. Participants have no say in how their account is invested. The trustee is subject to fiduciary liability when making investment decisions, but there's nothing in ERISA that says thou shalt always allow for directed investments. So there are some of them out there where there are no directed investments, and as a result, there is no QDIA. So the question is, if that type of plan is subjected to automatic enrollment, how does it comply with the mandate to invest monies that are not directed into a QDIA? And the answer is we don't know. Some have suggested that you just ignore it. If there is no directed investments, clearly it shouldn't apply. Others have said, well, put set up a QDIA, and if they don't, give them a choice between the pooled trust investment and the QDIA. But I'm not sure that really gets you where you need to be. The proposed regs just say comply with the DOL regs and don't add anything more. Again, this has been called out to the IRS. Further guidance will be needed on that point. The acceptable QDIs and the like, I'm going to skip through that. We're running close to out of time. Nothing really new there. Now we'll finish up with a couple of these points. QACAs, qualified automatic contribution arrangements, have been on the books since PPA 06. There are some out there, but they have not. Automatic enrollment generally has not been popular, particularly with smaller employers. I mean, some of the large employers have adopted it a while ago, but for better or worse, quackers, at least in a lot of the plan people that I dealt with, were not interested because of the automatic enrollment and automatic escalation. Well, guess what? If you got a client coming in and says, I need a new 401k plan, I haven't had one before, and I think I'd like this idea of a safe harbor, you should consider going ahead and making a quacka. The quacka is going to comply with the Secure 2.0 mandate, and it has some benefits that over the normal traditional safe harbor. In particular, safe harbor contributions to a QACA, whether non-elective or matching, can be subjected to a 2-year cliff vesting schedule, which, again, it's not a lot, but if you have a lot of turnover, 2 years could be a long time to be able to, that you may be able to get some forfeitures to help reduce for future contributions. And the safe harbor contribution itself is less as compared to the traditional matching safe harbor. The non-elective is the same either way, 3%. But in the QACA, the matching safe harbor is dollar for dollar up to 1%, and 50% on a dollar on deferrals of between 1 and 6. So the maximum match is 3.5% of pay versus 4% in the traditional safe harbor plan. And so it's worth considering for the lower cost and the vesting. Consider. It's worth having a conversation with the client. Correction of automatic enrollment errors. The point to be made here is that Congress added Code Section 414C to 2.0 that allows self-correction of reasonable administrative errors made in implementing automatic enrollment, auto escalation, or even for improperly excluding an employee from making an affirmative election in an automatic enrollment or escalation arrangement. And these are referred to as implementation errors. The good news is it's just like the current EPCRs, which this is better because it's in the code. The IRS can't sunset it. And in particular, the unlike the old EPCRs rule, you can use this method for a terminated participant who is eligible for correction without the need for having to make a QNEC. If you fit within this correction, all you've got to do is begin the correct deferral contribution rate by the earlier of either the first payroll date that occurs 9.5 months into the close of the plan year in which the error occurred, which is not coincidental that it ties into the deadline for the extended deadline for Form 5500, or if earlier the first payroll occurring after the last day of the month, following the month in which the employee notifies you and says, hey, I thought I was having amounts taken out. You didn't do it. Well, you've got to correct it sooner rather than waiting 9.5 months. But the correction is just to start deferrals up. If you've got related matching contributions, they've got to be made up along with earnings. The matching contributions need to be deposited within a reasonable period of time. Notice 24-2 tells us we've got basically 6 months. All right, last quick topic. As my father always said, it may not be much, but it's better than a stick in the eye. And I've always said, you've heard me say this before, I didn't say it to him, I knew better, but what's not better than a stick in your eye? Well, what is better is a $500 tax credit for small employers who include an IACA as part of a new 401k plan or added to the IACA to an existing K plan. Small employer is no more than 100 employees in the prior tax year that received 5,000 or more in comp. Credit is available for the first 3 tax years beginning after the IACA was first established. Since an IACA is mandatory for any new 401k plan, again, it's not a lot, but it's better than a stick in your eye. And with that closing happy note, we have reached the end of our time. I don't think I've gone over, but I'm going to be pressed for questions. But go ahead. Do we have any, Yvette?
We did have one come in, and that is if a participant enters on January 1st of 2025, when does the participant escalate to 4? Would it be January 1st of 2026 or January 1st of 2027?
I would say 26. If he entered the, no, I take that. I have to think that's a good question. It's the initial period is the plan year in which you enter in the following. So I guess I take that back. It would be 2 years if the employee actually entered on January 1st. Now, I would pose the question, how many employees start their first day at work on New Year's Day? There may be some, I'm just saying, but I think to that hypothetical, I'd be inclined to say you go the whole 25, 2026 year before they've got to be um, moved up to the 4% rate. So
Awesome.
I
All right.
guess if that is it, again, folks, thank you for joining us. I hope you enjoyed the webinar. Tune in follow our LinkedIn page. We certainly promote our webinars there, and we'd love to have you in the future. So until then, Fergie and I both say goodbye. We're heading out to the dog park, which the name of it is Brewhound, which means you can have a brew with your hounds. So not Fergie, me having the brew. Thank you, everybody. See you next time.
Thanks, Craig. Reminder to everybody, go ahead and click on the paper icon at the top of your webinar screen for today's presentation in PDF form. If you're not able to download it, you can always email us. To view any webinars you may have missed and the recording of this, you can follow us on our YouTube channel, which is Nova 401k Associates. For any other questions, go ahead and email us webinars@nova401k.com and stay tuned to the pop-up survey once this session ends. Thanks so much, Craig, for today's presentation, and thanks again to everybody for joining. We hope you guys enjoy the rest of your day. Bye.
Bye, everybody.